We have with us Sanjay Sethi, MD and CEO at Chalet, joining in on the show right now. Sanjay, great to have you on ET Now once again, and congratulations. A stellar quarter. Wasn't expecting anything different as well, but strong growth. Having said that, your PAT did get impacted by a one-off charge of about 18.5 crores or so. Could you tell us what exactly is this one-off? Sanjay, you'll have to unmute your audio.
Apologies for that, and good morning, Aisha. There was this one-off write-off that we had to take on our residential project on account of some historical costs associated with that. So we've taken that and closed that matter with this year. But we've done extremely well. If you really look at the quarter or the year that's gone by, quarter, we are now about 2.3x of last year, similar quarter. Our revenues are up 17% sequentially, and our EBITDA is up 36% sequentially in the hospitality division. On a consolidated basis, our EBITDA is also up 34% sequentially and 4.3 times last year, same quarter. The important thing is that the revenues have not only held up, they've grown aggressively between quarter 3 and quarter 4. Our costs have held, and thereby the EBITDA margins have improved significantly at Chalet Hotels. We've actually been able to report 46.4% EBITDA margin on a consolidated basis, whereas the hospitality part of the business recorded 47.6% EBITDA margin, which is extremely healthy by any benchmark. We've also managed to close the year at a healthy 500 crore EBITDA, with a margin of 43%. Our profit before income tax is 272 crores, and the total comprehensive income is 185 crores and change for the financial year. All in all, an excellent quarter. I think it's driven by few events that have also happened, which have taken very positive shape for Chalet and which will bear fruit in the coming years. For example, we signed our first hotel in Delhi, which is under construction now. It's a 400-room hotel. That's going to be a big win for us. We've also forayed into the leisure segment with the acquisition of the Duke's Retreat at Lonavala. In addition to that, we made very strong inroads on our sustainability goals. We've got roughly 1,200 crores of CapEx spent on projects that are coming into play in the near future, throwing up more than 20% EBITDA margin. So clearly looking very strong. It's been a great year and looking very strong here onwards.
Right, looking very strong going down the line. Just wanted to understand what the outlook is in terms of the commercial pipeline as well. Are you seeing steady rentals for the commercial portfolio? Are you seeing that the share of the rental income as well is likely to go up?
So, Abhi, yes. You see, we've got almost 1.7 odd million square foot of office space between Bengaluru and Mumbai coming into play in the next few months. Bengaluru's rental in the market is around 62 rupees. Mumbai is around the 125 rupee mark. So clearly, there's a huge upside again to gain from the office assets that we're developing. And we've got almost about 1,100 rooms under development on the hotel side. Overall, I think office business is a hedge for the cyclicality of the hospitality industry. So from that perspective, that's a great hedge and diversification that we have. But we are primarily a hotel company. And on the hotel side, our growth is very, very exciting right now going forward.
Sanjay, morning. Nikunj also joining in. Now, what perhaps everybody wants to understand from your vantage standpoint, do you see this cycle which is there in the entire sector, whether it is Chalet or whether it is Indian Hotels or whether it is any other hotel chain? Is this a multi-year cycle where prices will be strong, supply will be less and demand will be more? This could be a 2-3 year phenomenon?
Hi, Nikunj. Yes, I strongly believe that. And my gray hair, like you mentioned last time, is not a proof of anything else. We're blessed with a situation where the demand continues to be in double digit for the industry. And this is, of course, different for different markets within the country, but pan-India, that's the sort of growth that you're witnessing, especially in the tier 1 cities. Supply side is extremely muted at about 4.5% to 5% for the next 4 to 5 years. So that combination gives us a great run for the next 4 to 5 years, which is the foreseeable future. It's very difficult to predict beyond that, but the next 4 to 5 years look extremely healthy.
Do you think next 4 to 5 years they look healthy? Because ultimately, the hotel industry is a cyclical industry. We don't know what will happen next month, right? That kind of world we live in. You are giving me prediction for 4 to 5 years. I mean, the shareholders will be happy to hear it, but there has to be some thought behind it, right? So I'm
So
curious.
Nikunj, let me caveat that. Listen, leaving aside an event like the pandemic or something like that, we are pretty good on a year-on-year rise for the next 4 to 5 years. And this is this logic is a very sound logic based on the demand and supply situation. India's story seems to be strong. We do expect a lot of travel coming into India, both leisure and business, especially business going forward. G20 is just one event that's happening this year, but the repercussion or the benefit of G20 is going to be enhanced business engagement between various countries, and that's going to lead to a lot more business travel. India domestic business travel is very robust. It's growing very aggressively. It isn't pent-up demand. Unlike a lot of people who believe that initially it was pent-up demand, that's not the case. We are now in the 10th month or 11th month of month-on-month growth. So yeah, I'm very confident of this 4 to 5 years.
One is demand, second is the ARR. Do you expect that the growth in the ARR would be in sync with what the nominal GDP is, which is that if there is a nominal GDP growth of about 10-11% or 12 to 13%, ARR will be in line with the nominal GDP growth?
Well, I expect ARRs to be in the 8 to 12% range for the next 1 or 2 years. In fact, maybe even slightly higher. And at that point, after that point of time, I expect them to stabilize at that 8 to 9%. And that's where I see that holding. This is again driven by the fact that the demand continues to outpace supply. And in that situation, the rates, especially in the big cities, are going to rise, especially Mondays to Fridays. And that's going to drive the business. We've had a very high acceptance of the 30-odd% or 25-30% increases that we've done at the corporate contract front this year. There was no resistance at all. All everyone wanted was guarantee of rooms.
Now, the acquisitions that you've recently undertaken have been via your internal accruals. The Duke's Retreat, for instance, that is part of expanding into the leisure portfolio. Are there any more acquisitions in the pipeline, and will all of this be funded via your internal accruals?
Savannah, as I said earlier, we got about 1,100 rooms already under development. So a lot of the future capex is going in there. But the internal accruals are aggressive, and I think this will give us headroom for more acquisitions in times to come. We must also keep in mind that our debt profile is going to fall very rapidly from next year onwards. Two things are going to happen on the debt. 2,400 crores of debt today, 1,200 crores is for office assets, which are getting deployed as we speak. And that's going to create its own EBITDA to support that part of the debt. Also, the debt of 1,200 crores will move to LRD, which is lease rental discounting, which means the cost of capital will come down there. All of that combined together is going to create headroom for further growth beyond the 1,100 rooms or beyond the 2.5 million square foot of office space that we're speaking about. And as and when that happens, if the opportunities are right, we'll be very keen to look at them.
So Sanjay, really good to have you back. And yes, now I realize that grey hair sometimes is stress, but in your case, I think it is happiness and it is wisdom.
Silver lining, Nikunj.
Good to have you on ET Now. Thank you so much.